finish when I break the flow, I can now ask you the question. So what I'm saying in essence is that we have looked at the introduction to financial management, but there are some salient points and salient topics that we need to look at, or subtopics, like relevant costs, like decision making, uncertainty. You know, when we are making decisions, sometimes we make decisions based on the computations that we have done, based on the alternative available funds that we require, and alternative use of those funds. When we are looking at alternative use of those funds, we actually need to look at the one that will give us the highest return, maybe the accounting rate of return, the return on capital employed, the NPV, discounted payback, and all those things. We have to look at them. But in looking at them, we need to know the relevant costs and the relevant revenue that are available to us. Those relevant costs and relevant revenue or material, when we want to make decisions on production and all the rest, or material or labor, where we need to know that in decision making, we actually look more on variable costs, we look more on marginal costs, we look more on all those variable items, even variable overheads. Those are the things we consider to get our contributions. So we are going to look at relevant costs. What does it mean to say something is relevant, important, major? That's why you see that when we look at our cost element, we are looking at direct material, direct labor, and direct overhead or variable overhead, as the case may be. We are looking at those three items. When we look at those three items, we call them the major costs, the most important costs. Without incurring variable costs, we cannot enter production. Without incurring variable costs, we cannot plan. We cannot plan. And that is why we talk about planning as budgeting. And if you look at our budgeting, we always, try as much as possible to get the variable cost. We minus it from the sales to get what? To get the contribution. And that's why we call marginal costing technique. We call it contribution method. I told us that we have three stages that we look at in performance management. One is to identify the cost we incur, classify it, apportion allocate it directly to cost center, classify it to cost unit, allocate it to various cost centers. Then the one we cannot allocate directly because we cannot, identify it to a cost center, and it is a general cost for an organization. We do what? We share it, apportion it. Then there are other expenses that we cannot touch. We absorb them, we recover them. That's the meaning of absorption, recovery cost. These are when you identify those costs, you do them that way. Then there are two methods of doing what? Of arranging the cost you identify. I say we have marginal cost and absorption costing technique. And the marginal cost, we said it is contribution method. Then absorption, we said is total cost method. Now, we are looking at decision making. We use marginal cost to make decisions. We use variable cost to make decisions because they vary directly with level of activity. Without incurring them, you cannot do what? You cannot start production or services. Take, for example, the cost of data that you are using now. The cost of data that you are using now is a variable cost. If you did not incur it, it is a noun cost and a future cost. Because from now till probably around 11, we will be doing what? We'll be on this platform. All of us will be on this platform. So we will continue to incur that variable cost of cost of data. Cost of data. We'll be incurring it. So you will see that it is relevant to this our lesson or lecture that we are doing right now, that we are taking. It's relevant to this seminar that we are, or the meeting that we are having now. Because without it, you will not be able to connect. Those are the costs. Now, there are other intrinsic costs, hidden ones. And what are those costs? The cost of not hearing me when I speak because network is bad. The cost of being logged out and logged in. Those costs, it will take you to go extra mile to listen to the lecture or to again or to try and join those ones that you did not get. It will take you some time to be able to do that. And the way you do that is when you look at your books. When you read your books, you see those disjointed areas. You will now be able to link them up. You see, those costs will now become relevant because without it, without you being able to incur those costs as at when due, that is now and tomorrow or future. Tomorrow is future. Now is now, not past. Any cost that is past is not relevant. Any cost that is past is not relevant. You need to understand that if you have a cost and it's past, you have incurred it. Whatever you are saying is history. I spent 20 million on buying a land last 2 years. Is history. That's why we call it historical cost. That 20 million is an historical cost. And it is history you are giving us. How I will know is when I see your CFO or deed of covenant for that property. That's the only one. But if you are not saying it to me, it's history. I spent so amount to register. Those ones are history, historical. That is irrelevant information. There are those that registered with ICANN. Up to now, they are not writing. They spent that money to register, but they are not writing the exam. Some have taken lecture, they are not writing. When they tell you all these things, they are just speaking English. They are telling you history. They are just telling you history. And history is a past event. History is a past event. And every past cost, past revenue is what? Is irrelevant. So now we are going to look at relevant costs based on cash flow, relevant costs based on material costs, relevant costs based on what? Labor. When we understand relevant costs based on these three situations, we are also going to look at relevant costs based on labor. We start with relevant cost of cash flow. Relevant cost of cash flow. Before we enter variable costs, marginal costs, opportunity costs, and the rest. The material costs, the labor costs. So let's go. Relevant cost of cash flow. That is our subtopic now. Relevant cost of cash flow. What is relevant cost of cash flow? Relevant cost of cash flow must meet three conditions. Relevant cost of cash flow must meet three conditions. Number one condition is that it must be cash. I hope you are writing. It must be cash. Number 2 is that it must be what? It must be as a result of the decision you make now. You must incur that cost based on the decision you make to take this lecture. Now, after this lecture, that cost become sunk, become past, become historical. You have spent it, you spent it. If you gain a lot, you'll be dancing, you'll be jumping. But it's not enough for you to listen. You must study again. You must write and look at those things you have written. And remember all these things I'm saying. So it's very important. That's number 2. It must be as a result of the decision you make now. Number 3, it must be a future cost or a future cash flow. It must be a future cash flow. That's a cash flow that you will incur tomorrow. If you want to take lecture, you will still incur another relevant cost, variable cost, marginal cost, opportunity cost. Some of us will leave our job and be in class. The cost of leaving our job and being in class can be said to be relevant cost. It's an opportunity cost for God. An opportunity cost for God.
No questions, sir.
Now, these 3 conditions met. If you mean only 2, then that cash flow is not relevant. The cash flow is not relevant. Why is variable cost relevant? Variable cost is defined as unit cost of the product that varies directly with the level of activity. The cost of the product, the unit of the product that varies directly with the cost, with the level of activity of the product. What does that mean? The variable cost is 0. Your quantity will be 0. As a variable cost is that cost, that unit cost of a product that varies with the level of activity. Level of activity is the same thing as output. It's the same thing as output. So I want to go to the board now to demonstrate it. If you have level of activity 0, it means you will not incur variable cost. But immediately you incur variable cost, it's either you produce 1 unit of a product. So, but when you have 0, your cost, your variable cost will be 0. Because to start production, you must incur variable cost. Look at my board. I have quantity, which is level of activity. Then I have variable cost. Variable cost. So if I have 0, it means I have not incurred variable cost. If I have 1, and probably my variable cost is 100. If I produce 2, it means I have got what? It will be 200. It varies directly with the level of activity. If I produce 3, it will be 300. 4, 400. 5, 500. Now, it is not just that variable cost is a relevant cost. It is variable cost per unit that is a relevant cost per unit. And that is why we want to calculate the variable cost per unit. Variable cost per unit. Let's assume this is our A and this is our B. So variable cost per unit will be B over A. To get our variable cost per unit, that would be B over A. 0 over 0. 0. 100 over 1. 100. 200 over 2. 100. 300 over 3. 100. 400 over 4. 100. 500 over 5. 100. You will see that variable cost per unit is a relevant cost because it varies and it is now cost and is a future cost and it's as a result of carrying out production. So it met the first condition, cash. It must be money you pay. Like you are paying money now for your data. If you use 100 data, probably it's 5 naira per MB. You use 100 MB. That will be 500 MB that you have used. Million bytes that you have used for this your data. If it's 10 naira, that is 1000 MB. Is it? I think so. Are we there? So the variable cost is the unit cost of a product. That's variable cost per unit is the unit cost of a product. And you can see that the variable cost is fixed. Variable cost per unit is fixed, irrespective of the level of the activity. Variable cost per unit is fixed. I've demonstrated it on the board. Irrespective of the level of activity, it's fixed. And that's what makes it relevant because it is cash. It's as a result of entering production and it's also a future cash flow. Because if you produce 10 tomorrow, your total variable cost will increase, but the total variable cost per unit will remain constant. So variable cost is a relevant cost. Let's look at marginal cost. The definition I give to marginal cost is that marginal cost, that's MC, is the extra cost. You can see I put extra. The extra unit cost of producing an extra unit of a product. You can say it's tautology, but I did it this way so that you can understand it properly. You can say marginal cost is an extra cost of producing an extra unit of a product, but I say unit cost because we classify cost into units. That is, we give a name based on units. Traveling expenses, it's a unit cost. Wages and salary, it's a unit cost. Depreciation, it's a unit cost. Are we there? They are all classified and given a name. Classification means give a name. So, variable cost, marginal cost. Now, marginal cost, I said, is the extra cost of producing an extra unit of a product. The extra unit cost of producing an extra unit of a product. Now, I hope you are seeing my board. Let's look at marginal cost. MC.
I'm not seeing the board well.
Can you see it now? Can you see it now?
It's okay now, sir.
Okay.
Okay.
Now, I said marginal cost is the extra cost of producing an extra unit of a product. Marginal cost we didn't produce, it will be zero. Abi? We didn't produce, zero. Zero quantity, zero marginal cost. When we produce extra unit, which is one, what is the marginal cost? Is the cost of producing an extra unit, which is 100. Is that not so? So if our marginal cost is 100. When we produce 2, it means we produce another extra. That would be, and what's the cost of 2? The total variable cost of 2. That's 200. If you minus it from 100, you have 100. So the marginal cost under 2, the extra unit is still, the cost is still 100. 300. 300 minus 200, 100. 400. 400 minus 300, 100. 500. 500 minus 400, 100. You can see that marginal cost is 100 at every level. Variable cost is 100 at every level. What it means is that if your variable cost per unit is equal to marginal cost per unit, and we say variable cost is per unit is relevant, what it means is that marginal cost per unit is relevant. Another terms or type of cost that we want to look at is incremental cost. I call it IC. IC, incremental cost. I call it IC. The definition I give to incremental cost is the cost by which an extra unit or the total of an extra unit increase, the total by which an extra unit increases, I call that incremental cost. Now, if you look at the board, the quantity increased to 1. It means from 0, it increased the total variable cost increased to 100. So the incremental cost will be 0 here, will be 100 here, under 1. When the total became 200, it increased from 100 to 200. By what? By 100. From 200 to 300. By what? By 100. 400 to 300 to 400. By what? 100. 400 to 500. By what? 100. Since incremental cost is 100, based on this example on the board, on our schedule, what it means is that incremental cost is a relevant cost because it is equal to marginal cost and is equal to variable cost per unit. Are we there? Now, another term is differential cost. The difference between the previous cost, total variable cost, and the present total variable cost. That's differential cost. Let me put it here. I call it DF. Differential or DC. Let me put DC. If you don't like DC, you can put DFC, differential, or D small f and C, capital C. But let's leave it at DC. Differential, what's the difference between the previous cost and zero? Zero. The difference between 0 and 100 is 100. 200 and 100 is 100. 300 and 200 is 100. 400 and 300 is 100. 500 and 400 is 100. What it also means is differential cost is a relevant cost because it is equal to incremental cost, is equal to marginal cost, and it is equal to variable cost per unit. Why is opportunity cost a relevant cost? It is a relevant cost because it is a cost foregone. In accounting, we define opportunity cost differently from the way it is defined by the economists. In accounting, we have two types of opportunity cost. We have internal opportunity cost and external opportunity cost. It's almost the same with the economist, but a little bit different. Now, what is internal opportunity cost? Internal opportunity cost is the alternative foregone internally. Let's take, for example, an hotel. You are a producer of bottled water. An hotel asks you to produce some cartons of bottled water. The machine with which you use to produce your own bottled water, Balaku Textile, Balaku Waters, Balaku Waters. You use it to produce, you now use that machine and start producing, you now want to cost the production of that hotel. You are going to use the machine and move it and use it to produce Balaku's waters. What it means is that you might lose some money because if you don't produce your own bottled water, you will not sell. You might lose some money, you might even lose goodwill when your customers come for your water. Balakus water, and they couldn't find it. You might lose goodwill. So the cost of goodwill, or the cost that you of sales, that's the sales you will get from it. That money you will get from selling that period, maybe 1 month, you did not sell Balakus water, or you lost like 10,000. That 10,000 naira must be added to the cost of producing for the hotel. That's what makes it relevant. That alternative for God is an internal alternative. External opportunity cost is when, if you use that, assuming you are not using that product, that machine, and the hotel comes to you to produce that bottled water, but you can rent out that machine and make 10,000 naira by renting it to an outsider. But you ended up not renting it. You use it to produce for the hotel. That rental income that you are supposed to generate for renting it out is an opportunity forgone, opportunity cost forgone, that must be added to the cost of producing for that hotel. So the hotel must pay you that 10,000 naira. Now, it is an external opportunity cost. That is the difference between internal and external. But in economics, we look at scale of preference, then you make a choice. It's in making a choice, because we say that there is scarcity of resources for production. To do what? Have a scale of preference. That is, those items you prefer to produce or sell or buy, whichever, you now draw a scale of preference. In your scale of preference, you now put the items: rice, beans, yam. Rice first, beans second. Then you have yam third. It means that you have chosen to buy yam first with the available resources. If the resources is not enough to buy beans, what it means is that you have forgone beans. The opportunity cost by an economist is the beans you forgo. Let's assume that the rice is 60,000 for 50 kg. Beans is 80,000 for 50 kg. Now you bought rice, 1 bag, 50 kg, 60,000. That's the cost, the price or the cost of rice. 60,000. The cost of beans, 80,000. I hope you are writing. The cost of rice, 60,000. On your scale of preference, the cost of beans, 80,000. 50 kg of yam, 50,000. Now, what it means is that if you buy rice and forgo beans, the opportunity cost is beans, not the cost of beans. The opportunity cost is beans. That is the beans you forgo, not the cost of beans. The opportunity cost is not 80,000. it is beans by an economist. Then the economist now went on to say that there is a cost that is attached to beans. That is the real cost that you forgo. That is the real cost. So the real cost of rice is the cost of beans, which is 80,000. The real cost is 80,000. That is the way the economists define his own opportunity cost. Opportunity cost and real cost. That is, real cost is an opportunity cost, but it is the cost of the alternative forgone. Why the accountant does not differentiate the alternative forgone and the cost of the alternative forgone. To an accountant, the cost of the alternative forgone is what? Is the cost, not the item itself. So that is opportunity cost. And because we have to add it to the cost of what? To the cost of that job, it makes it a relevant cost. It makes it a down cost because you forgo it. I gave you an example before that some of us must have forgone sleeping to be in this class. The cost of sleeping is the opportunity cost, and that is the cost you will incur, additional cost you will incur, apart from the variable cost you will incur for this lecture. It is the cost of sleeping that you did not sleep because you need to be in class. That is the opportunity cost, and that is what makes it relevant. So opportunity cost is irrelevant. Those costs you can avoid are those costs that are relevant in decision making. But those costs that you cannot avoid, that are imputed, apportion costs, past costs, they are irrelevant in decision making. We also have commitment costs. That's another terms we use in accounting or financial management, even performance management. Commitment cost. Commitment cost is irrelevant. Take, for example, you buy a photocopy machine, a new photocopy machine, and you need an after-service service after you buy you need servicing of that photocopy machine that you need to pay for, and in the agreement you have committed that they will come at least once every 3 months to come and service that machine. You will pay 10,000. That 10,000 naira cost is irre in making decisions. It's irrelevant. It's committed cost. You have committed yourself to pay. You are taking lecture. You committed to pay. You paid part. Said you will pay next week. You just decided, okay, I decided I'm not going to pay again. You are already committed to that cost. You have to pay it. It's a committed cost. So it's irrelevant in making decisions. The same thing, past cost. The same thing, sunk cost. Past cost, historical cost, they are all past costs. You can't use them to make decisions. So when we are preparing our appraisal, that is in financial management, when you are doing something like investment appraisal, you look at the cash flow, the thing that relates to cash. Estimate, you don't bother yourself. You don't bother yourself about provisions. You bother yourself about the real cash inflow and cash outflow. Even when you are doing your appraisal to get your MPV, discounted cash flow and all those things, you look at the real cash flow, the relevant cash flows, the relevant costs, the relevant revenue, not estimate, not assumed revenue. Because they are the things that are relevant. So in preparing your investment appraisal or carrying out your investment appraisal, carrying out some of these, your appraisal, business valuation, all of them, you always look at your what? Your relevant cost. You look at your relevant cost. Are we there? In relevant cost of material, we are going to look at two scenarios. Scenario one is that material always in use? The material, is it always in use? I'll call that one in use. If the material is always in use, the relevant cost is replacement cost. The question is, this material, we have established in this class that we have established in this class that historical cost is irrelevant. That is history, that we are just telling history. So we say it's irrelevant. Historical cost is irrelevant. So the historical cost of your material that you have in your store, Omo, you name it, soap kg, or so names. You have them in your store, you have bought them. They have historical cost. Your machines, plants, generators, they have historical cost. If they are machines, they have historical cost. You are selling generator. You have already bought them. You are selling them. That cost is history. You have spent it fast. That is to make decision. What you can use in making decision? What is the present cost now? Or what is the replacement cost of this material? If you are always using it, you are always selling it. You have a generator, you buy about 5,000 generators, sell them, and it's going down. You want to look at replacement, what to replace them, you look at the replacement cost because material items you sell, goods you use for materials and all those things before you add labor and the rest. You need to be buying them from the market. And the cost does not, sometimes it goes down, sometimes it goes up. But mostly in this part of the world that we are in, it goes up. So it's the replacement cost. If you don't have the replacement cost, that is when you now start talking about the market cost. If you don't have the market cost, you now talk about the current cost or current price, replacement price current price, or we talk about the market price. They are still costs. But wherever you have replacement cost, you have current cost, you have what? You have market price. Please, the relevant cost is the replacement cost. It is where you don't have replacement cost given to you. You choose market price or current price. But they will always give you one of each. But if they give you two, there must be replacement cost. So you use replacement cost. That is the relevant cost. When that material is always in use, because as it's going down, you'll be replacing it with the replacement cost. That is the first scenario. The second scenario is that if that material is not in use, it's not always being used, or you are just abandoned the material because you don't want to use it again for, you don't see the product you want to use it for. If that material is not in use, you look at the opportunity cost. Like I said, opportunity cost is the alternative for God, the cost of the alternative for God in accounting. So you look at the opportunity cost. But what you are going to look at in the opportunity cost is the higher of the two. Because for you to forgo something, there must be two. There must be an alternative to one. So there must be two or three. So you look at the opportunity cost. I call it OC. And you now look at the higher of the higher of benefit forgone or scrap value. SV, scrap value or residual value. Scrap value or residual value. The opportunity cost, but higher of. That will be the relevant cost, whichever that is higher. Take for example, if the scrap value is what? If the scrap value is 1,000 and the benefit forgone is 2,000, which one is the opportunity cost? Brilliant students.
Please, repeat yourself again.
If the scrap value is 1,000 and the benefit forgone is 2,000, which one is the opportunity cost that you will use or that you use?
2,000.
2,000 because it's higher up, and 2,000 is higher than scrap value. Let's say, for example, benefit forgone is minus 500. Scrap value is 100. Madam Esther, Please answer.
500, sir.
No, minus 500. Minus 500. And star value is 100. Which one will you choose? Which one is higher? Plus 100 minus 500. Which one is higher?
100.
is higher.
100. Brilliant student. Brilliant student. All right. Now, let's look at in relevant cost of labor. Relevant cost of labor. There are three conditions that need to be met in relevant cost of labor. Number one condition is that labor must be variable. Don't forget that we said the variable cost is relevant cost. Labor must be variable. Don't forget that labor is a direct cost. When you are looking at direct and indirect or direct and indirect, variable cost. When labor is variable, is irrelevant for that one condition. It must be variable. Number two condition. When labor is fixed, when labor is fixed and it has spare time, S-P-A-R-E, spare time. The relevant cost is 0. I want to explain. When labor is fixed, take for example, you are being paid salary at the end of the month. That is the agreement. Agreement is agreement. Now, you went to Umwell here to go and do a job. Will they add to the salary?
Salary is already fixed.
Who is answering me?
No, sir.
The salary is fixed.
Will
No,
they
sir.
add to your salary?
No, sir.
Because you have a set time. A set time, they will send you to go to Abuja from Lagos. They will pay your expenses. They won't add to your salary. That's the time. So the relevant cost of that journey is 0. That is number two condition. I thought the number one condition is that labor must be variable. If it is variable cost, variable cost, relevant cost. If it is variable, it means it's relevant. Number two is that if labor is fixed and you have spare time, the relevant cost is 0. 0.
Come again, sir.
Number three condition is if labor is fixed, but no spare time. The relevant cost is the opportunity cost. If it is fixed, that means it's fixed salary, not wages, salary. And there is a job done in Umwa here. Take you to Umuahia. Somebody to put you up in Lagos or Abuja or wherever your station is. Take someone to that job. While you are going to Umuahia, now they will pay that person. That cost must be part of the job you went to do in Umuahia. To be part of the cost of you went to do in Umuahia. Because if you had not left your station to Umuahia, what will happen? You continue your job, and that job will not suffer. But if you lose 10,000 naira for going to Umuahia, that 10,000 naira is an opportunity cost forgone that must be added to the DC because you don't have spare time. Somebody must do the job, or you will lose money. And that money they pay the person, or the money you will lose is an opportunity cost. It's a benefit for God. If it is what you are going to, the company is going to earn some revenue, like 10,000 naira for that period, they will lose that 10,000 naira. So that 10,000 naira they are losing must be added to the cost of going to Umuahia. So Umuahia job will bear the cost. That is the three conditions for what's it called? For labor. For labor. For labor.